Welcome back. Earlier today, PPI Producer Price Index was reported softer than expected and also softer than the prior month. We have upcoming jobs data and some big economic numbers to analyze before the next Fed meeting, to be sure. But for the moment, I want to take a little bit of a sidetrack to look at an alternative way at looking at the market. Now, the purple area chart in the background, that's the S&P 500 from March 22 through present day. Now, we see here the green line is the VIX, the volatility index. Now, we know that's commonly referred to as the fear index. It's made up of the front month options on the S&P 500. Generally speaking, when there's fear in the market, when the market's going down, traders will buy puts or sell covered calls. They become more active in the options market, the premiums rise, and the line goes up. So when stocks go down, the VIX goes up and vice versa. But what some may not know is that there's not only a VIX, a fear index for the S&P 500. There's actually fear indices for several different markets. The blue line here shows us the VIX for crude oil. The red line shows us the VIX for the gold market. Now, they work in the same fashion, and they all track the prices and the level of fear or uncertainty in their own respective markets. Meaning when crude oil goes down, then we'll see the crude oil VIX go up. When the S&P 500 goes down, the S&P 500 VIX goes up. So I thought it might be helpful to take a look at these different VIX fear indexes to really get a different gauge on which way the market's going, because after all, these markets are very linked. You know, there are correlations between gold and the dollar, so on and so forth. But especially, I think, with crude oil, for example, when there's a fear of recession, consumers spend less money. They buy less new automobiles, and they spend less, money traveling, so to speak, as well. So the consumption of crude oil, the consumption of commodities and other indices goes down as well, and therefore that VIX may also go up. Now, taking a look at the average VIX. Now, the average VIX is a line that we made up. That's the white line here. That's made up of the average of the VIX for the S&P 500, for gold, crude oil, the NASDAQ 100, which is heavily weighted towards technology stocks, and the Russell 2000, which is heavily weighted towards small cap stocks. Now, if you take the average of all of these different fear gauges and put them together, that's what we have here, the white line. The blue line is the S&P 500. So notice over time, first of all, we go back to 2016, 2017. The S&P 500 enjoyed a very steady trend to the upside. The VIX remained very low. Now, this, again, takes into consideration not only stocks, but also oil and gold. And within the stock market, the technology stocks and the small cap stocks. So it's not just based on the S&P 500, which are very large market capitalization stocks. Notice those periods of time when the S&P 500 goes down, such as February 18, the VIX rises. Now, we know the normal, or let's say the standard VIX, we have specific levels that we watch. For example, take a look back at this chart. The standard VIX that we watch is the green line. Now, we have indications 10, 20, 15, 20, even 25. That usually occurs with very strong markets when the VIX is low. When the VIX hits a level of 40, that usually indicates the stock market's going down a lot. Every so often, maybe once every decade or so, we have a huge market sell-off, and then we'll see VIX at a 60 level or even higher than that. Now, the average VIX has different parameters just because it's averaging in a lot of different fear gauges. But take a look to see, for example, the average VIX reading went up to a level of 100 April 2020, when we know March, April, the stock market took a major hit. And then conversely, when the S&P 500 made all-time highs, we see the VIX was down near the 20 level. Generally speaking, we can extrapolate from this that strong markets, we tend to see the VIX average around the 20, even 30 level, but not more than 40. and that when it is above 40 or even close to 40, that indicates that the overall trend and tone of the market is pretty negative. Now let's zoom in on the first quarter 2020. That's that huge stock market sell-off that we all remember. The blue line is the S&P 500. The green line is the S&P 500 30-day moving average. Just tracks the price over the past 30 days, gives us the average. Well, notice before that, late 2019, early 2020, the VIX average was around the 20 level. Very steady to the downside. Very happy markets, very low average VIX. All of a sudden, the market collapsed. The VIX skyrocketed higher, hit levels of around 80 and even again almost at the 100 level. Now, remember, this average is an average of many different markets. So why did the stock market hit a low in March, but the VIX average, or the average VIX, hit a high in April? Well, we'd have to zoom in. Maybe that was because oil had made a separate move, or maybe the price of gold, had made a different move. But generally speaking, we can surmise that the average VIX can give us a very, very insightful look into the tone of the market. Again, when it's near the 20 level, that means markets are quite strong and that there's a lot of confidence out there. Notice the recovery. The VIX came down again. Let's zoom in. And this is 2020, 2021. The blue line again, S&P 500. The green line, 30-day moving average. Notice how the VIX just came down from the 40 level, had a nice steady trend. You can actually draw a trend line across the tops over here, and we can see a real steady decline in the average VIX, and very, very happy stock markets if we were to, for example, buy the S&P 500 when it comes down to the moving average. That looks like a pretty good strategy to implement. Now, there's nothing special with the 30 moving average. It just happens to contain most of the market activity at this point. So we can see, again, VIX 20 to even, let's say, 25, 27, very happy stock markets. Now, zooming in on present day, this goes back to January 22 through present day. We see the stock market has been very choppy indeed. Below the 30 moving average, popping back up, below, back again. Currently, you may wonder, the average VIX is around 27 at the moment. So we're in the level right now where the stock market, generally speaking, likes to go up. Just recently, we saw a VIX above the 30 level. Now, how can we use this? Well, of course, I wouldn't necessarily tie an entire strategy around this, but it certainly is a great source of confirmation. So, for example, if we have investments in the stock market, long-term, short-term, whatever it may be, and we say, okay, I'm going to hold on to my stocks, but I want to get out if things start to look shaky. Well, personally, based on these charts, at least, the data does suggest if we see the average VIX above 30, I think that spells trouble. As long as the VIX stays near between 20 and, let's say, 27, right basically where we are now, that looks like stock markets like to go up. If we start to see the VIX near the 30 level, above 30, 35, I think that indicates that there's some trouble on the water. Now, that we don't know if that average is going up as a result of small cap stocks or oil, but it's not going to move based on one index. It's going to move based on several indices, meaning that traders are selling the S&P 500, and there's not so much investment in the small cap Russell 2000 stocks either. And now the price of oil is going down because there's news that maybe, the consumption of crude oil is going down as a result of weak economic conditions. It's going to take a confluence of several different factors in order to get this average VIX higher. But we know when it does go up, that usually spells, shaky market conditions. And lastly, we could use a buy low, sell high approach, meaning let's say I want to buy the stock market after it's gone down quite a bit. If you think that we're not going to enter a major recession and then maybe we're going to have another spillover stocks, when would we want to get in? Well, this looks like it's a pretty dependable level. 35 to 40 seems to be a point that after the market goes down, it bounces back up. So if you see the average VIX near 35, 40, maybe at least for a short-term swing trade, maybe that would represent a good spot to get involved. After all, we see October, November of 2020, S&P 500 hit a low near 3270. Take a look at the average VIX was around 42, 43. Hit a level again around 35, so January 21. So it really is up to us to decide, okay, where do I think the long-term futures in terms of the market? If we're bullish, if we think it's going to go up, maybe we use the VIX as a contrarian indicator. If we're a trend following type of trader and we want to, try to trade in the same direction, then I think the VIX, at low levels looks like a strong stock market. Below 27, above 30, 35, it looks like down markets. We hope this has been helpful. We look forward to seeing you back soon.